Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. It's my great pleasure to once again bring you another subscriber request Tuesday video. This week, I was asked by several subscribers to cover Walgreens Boots Alliance. The company just announced their quarterly earnings report a couple weeks ago. I think it was October 14th. And there's been a lot in the news. They had one day that the stock was up like 7% or so. So it's a stock that's basically got the attention of some people now. So I thought it would be a great one to cover. I will do a quick comparison with CVS at the end, but I'm going to primarily focus today on Walgreens Boots Alliance. And I'm going to utilize our fast fundamental analysis template, if you will, where I'm going to go through 15 key metrics that I look at. And primarily what I'm doing with these metrics, and I want to be very clear about this, I want to give you information that, would help you determine whether a stock is actually research worthy or not. In other words, does the stock appear worthy of really conducting a more comprehensive research and due diligence? But this is a very quick, fast, fundamental approach that can allow you to determine, what type of company you're looking at and whether it merits further scrutiny or not. So let's go ahead and get into the video and let's look at Walgreens Boots Alliance. Now, the first thing, as I pointed out, I like to look at operating earnings growth. Okay, so I'm using the metric adjusted operating earnings here. And I'm looking for long-term, intermediate term, and even short-term, but even more importantly, forecasting, which I'll get into a little bit later. But the key is going back to 2002 here on this graph, Walgreens has grown earnings by 8.54%. Now, I shorten that time frame to where just coming out of the Great Recession, earnings growth has been about 6.1% because now I've got the effect of a relatively weak 2020. Now, the company has an August fiscal year. I want to make that clear as well. And so they just reported in October. It usually takes a company about 45 days to report after the quarter ends, in this case, after the fiscal year ended. So, we had a pretty nice earnings report come out for the company. They actually beat earnings for the quarter by 15 cents, and they also beat revenues by about $869 million. So it was a pretty good quarter, and it got a little bit of interest in the stock. Now, the stock price, the monthly closing stock prices on the graph here show quite a few things. There's quite a bit of volatility in this stock. So that's something else that I do want you to basically recognize. If you look at this from the longer term graph, you'll notice that there was a whole period of dead money here lasting almost a decade where Walgreens stock was really way overvalued, because the next thing after earnings growth that I want to look at is valuation. You make your money on the buy side, as I always say. And right now, with a blended PE ratio based on operating earnings of 9.64, I would consider this stock extremely inexpensive. The earnings yield is over 10%, 10.38%, and the dividend yield over 4%. So this would be very attractive from an income point of view. A weakness here, of course, would be the stock price, having fallen for the last several years as a result of this weakness in earnings that we saw in 2020, and a lot of it was COVID related. The third thing I like to look at then is the dividend growth trend, if any, if the company pays the dividend. So I'm going to go into the performance report here, and I want you to note that long-term, this company has really produced a very strong average growth rate of the dividend of over 15% and a compounded average growth rate of over 15%. Now, more recently, the dividend growth rate has slipped, so I'm going to shorten the time frame to the last 9 years here, and you can see that we're averaging about 6% since 2015. But the point is, we are getting nice dividend growth, and the company does have a payout ratio that's low at about 38%. So the dividend growth trend is solid. Long term, it's great. More recently, it's still very solid, growing at least as fast as the dividend of the market or slightly faster. So I like that. Now, and then the next thing I like to look at is number 4 would be reasonable return expectations. And to that, I can turn to the forecasting calculator. Now, I can do that on the historical graph, which includes a couple years of forecast, but you're using mostly historical growth when you're doing that. So when you go to forecasting growth, I do want to make this point because I get questions on this all the time. I'm looking at what the future growth is going to be. I can learn from the past, but I can only invest in the future. So this company has followed their 18 analysts and 16 analysts for this fiscal year, which ends in August of 2022, and next fiscal year, which ends in August of 23, that are forecasting a flat year this year. And that's, consistent across different earnings expectations that I've seen, followed by 5%, then followed by 8%, which gives us about a 4.37% average. Now, if I used a 15 PE ratio, again, I'm looking for reasonable return expectations. My returns over the next 2 years would be significant, over 30% over the next 2 years, and like 75% for this fiscal year, which again, ends in August 31st. So the bottom line is there is a lot of upside here, not so much from earnings growth, but from PE ratio expansion. Now, the normal PE ratio in the stock has been much lower at about 11.56 over the last 5 years. So if I'm looking at how the market's been historically valuing it over the last 5 years, I still get 29% and over 17% growth. So I've kind of run some what-if scenarios here, and that would be based on a PE of 11.56. rising from a current PE of 9.64. So I've got very reasonable return expectations. Now, I analyze this much more fully when I'm going through this process. I'll look at the analyst scorecard. This company has an excellent analyst scorecard except for last year. This is on the 1-year forecast. They beat estimates most of the time on both the 1 year and the 2 year. So it does have a good forecasting history. Analyst expectations have actually been dropping. Since 6 months ago, they were forecasting 517 for the 2022 fiscal year. Then it went to 505 and then to 491. And now it's kind of inched up a little bit because of that good quarter I mentioned, back up to 492. And we see a similar thing going to 216. Now, even though I've got more estimate data here, I've got fewer analysts. I don't like to go out more than a couple years personally. I just think, and then I keep trying to monitor that. But I do have reasonable return expectations here. Number 5, I also look for investment grade, which is triple B minus or better. It's triple B, 1 away from triple B plus, which is then 1 away from A. So it's got a good credit rating. It has a 53% debt to capital, which might be a negative, which I'll get into later. I do want to go through diluted earnings here with you real quick because I get this question all the time. The blended PE that you'll see in a lot of other sites will be higher than that 9. It'll be closer to 18 because the company did have a major loss in non-cash charges on diluted earnings in 2020, which, I'll let you dig into the details of that itself. But what I'm really looking for next, which would be number 6, would be free cash flow covering the dividend. The company has a good dividend record. It's a 4% yield. Its primary attraction right now statistically would be a significantly above average yield with 5 or 6% growth in recent history. The key is free cash flow is covering that dividend. Now, debt could be an issue at some other point, but right now, I see the free cash flow covering the dividend as well as operating cash flow, which covers the dividend as well. So, which would be number 7. I want to see the trend in the cash flow from operations growing over the next 3 to 5 years. Here, it's kind of iffy. So maybe you could argue that it's flat. The last couple of years, it's been growing and expected to grow next year. So, this would be maybe if I was giving it an A to F report card, I might call the number 7 cash flow from operations trend maybe about a C. Okay, but it's not horrible. It's not an F, and it's certainly not failing in that regard. And I think that's critically important. All right, so I'm looking at cash flow. Now, next I want to go into fund graphs, and I want to start looking at some of the financial underlying numbers, which is what the fund acronym is. And what I'm looking at here, the first one, I like to see operating cash flow, which is the royal blue line on this particular fund graph, be higher than their net income. Now, they didn't generate much income in 2020. That's something that's, pretty significant. But then if I go and take a peek at this quarterly, you can see that their net income is improving a little bit here quarter to quarter. And their operating cash flow has also, kind of stabilized a little bit. So, looking at it from a more long-term trend line, I do have operating cash flow or cash flow from operations higher than net income. I also want to see sales growth. So I'm going to click revenue or sales growth here. And I've got decent sales growth. My sales went from $76 billion in 2014 to $121 billion. But that is down from 136, almost 137 billion in 2019. If I look at quarterly revenues, They seem to be stabilizing pretty good at, 3.5, 3.5, 3.4 billion, as I mentioned. The company's actual revenue over their last quarter was over 34 billion, which again, that's this number here we're looking at, which was 869 million surprise for the actual quarter. So, I see that moving in a real positive direction. Then I'm going to go look at some ratios here. I want to look at debt to equity ratio first. I'm going to go to debt to equity ratio. I've got a debt to equity ratio of 1.32. That meets my 1-to-1 minimum industry norm criteria, so I kind of like that. And then I'm going to go and I'm going to look at gross and net margins. Now, retails does tend to have very, very low net margins, but this company is pretty much within industry norms on both gross and net margins. Their gross margins have been in the 19 to 20% range. Their net margins have been down into the 2 or 3% range, and they actually had none. That was for the most recent quarter. Looking at it longer term, looking at the annual numbers, on the gross margins, and expanding this out to like 14 or 15 years, their gross margins have been dropping. There's some reasons for that I'll get into, and their net margins have also been dropping. So I would kind of grade that kind of poorly as well. Now, asset turnover, which would be simply assets divided by sales. I would go into the balance sheet and I would look up assets, and then I would go to the income statement and do revenues. And the company has a decent, amount of asset to sales turnover. They're turning over their assets rather nicely for a retailer like in the healthcare sector like they are. Return on assets, I'm looking for a number that's 10% or better. I'm not going to get that in the retail sector. In fact, our return on assets have been weak, and they really weakened here in the last year or so. If I look at this data quarterly, they're starting to eke up a little bit of an increase, so there is hope for improvement. The company's doing a lot of things to try to improve. Their return on equity, I would normally want to see 15% or better, but that's, again, you're not going to see that in the retail sectors. But I do have improving returns on equity in the in the last couple of quarters. My long-term returns on equity have been 15% or better. It was just last year that their return on equity was pretty low. All right, but now there's a lot of other, mitigating circumstances here. So that's going through the company, if you will, through my 15 processes. And, the bottom line is I do think the company has some investment appeal. It does have some issues that investors should be concerned about, which is the reason why the stock has performed so badly over the last 4 or 5 years. Okay, but the company is doing a lot of things. They're making a lot of acquisitions. They're initiating new programs. By the way, the company is the world's largest purchaser of prescription drugs and several other health and well-being products. I think the company ranks number 19, if I'm not mistaken, on, the Fortune's top corporations, Fortune 500's ranking of the largest corporations by total revenue. So it's definitely a strong business from that point of view. The company has recently reorganized with the merger between Walgreens and Boots, which they had already owned a piece of. They've initiated things like My Walgreens memberships. The Village MD is something that's causing a little bit of issue right now with some of their numbers, but it's still another initiative, and it's designed to support the opening of 600 to 700 Village Medicals at Walgreens primary care clinics, as well as the acquisition of a majority in IA, a leading-edge producer of software pharmacy automated solutions. So the point I'm just simply getting at is the company's doing a lot of things. In the third fiscal quarter of 2021, they launched the online doctor. They're launching a business-to-business service called Test and Protect. So the company is very dynamic right now, which I think is having some effect on its financials. The real question is, are they going to turn this into future growth? They are, according to management, they do feel like they're making progress in transforming the pharmacy business and delivering healthcare through physical stores and digital channels, which is their current focus. They're also expanding nationwide home-day delivery. So, their transformational cost they refer to, they delivered $2 billion in annual cost savings during the fourth quarter alone. They expect that to continue. Over the next 3 years, the company actually expects annual adjusted earnings core growth of around 4%. As I showed you, earlier, that's this number here that you're seeing. They do expect flat growth in fiscal 2022, which I, showed you here. But then they also, each year after, they expect earnings growth of 11 to 13% as the faster growing and higher margins in the Walgreens Health achieve scale. So they're working to build that scale. Now, analysts are currently giving them only about a 4%, 3 to 5 year long-term growth, but the company believes that once they get past like 2023, they should be serving double-digit growth. So if you're looking at it as a long-term investor, they could be very, very interesting. Now, there are reasons to sell. The companies, like most in their whole market, they're facing persistent reimbursing pressure. According to Zacks, their share price performance, of course, has been awful for the last several years. But as you can see, it's been improving over the last year or so. We've had a nice little pop-up in it. Again, it had some, pretty good results here recently in the last week or so. Their pressure on margins is continuing, but that hopefully will improve. And they do have a highly leveraged balance sheet. Now, the company does have about $40 billion in debt, but only about 8 or 9 billion of that is actual pure debt. The rest of it is operating leases, which is a new accounting convention, which is very typical in their sector. So from a valuation point of view, there's a lot to like about Walgreens Boots Alliance, in my opinion. However, I did promise you that I would basically give you a brief look at CVS as well, which I think I'll cover later on this week as a separate entity, if not tomorrow. But the key is there's things I like. I actually have a much larger position in CVS. I am long with a small position in Walgreens. I'm longer in CVS, but there's some yin and yang here as well. And I'll save when I get covering this specifically. I'll just give you some highlights now. I like the earnings growth better in CVS, and I like the price performance more recently. Although the company has froze their dividend for the last several years, and it's still anticipated they're going to maintain that $2 dividend for the next several years. So that would be a negative if you're looking for dividend growth. But the company also has very good valuation. You can see that they've also gone through some issues with diluted earnings, as I pointed out with Walgreens. Their operating cash flows cover their dividend very nicely. Their free cash flow covers their dividend very nicely. And I'm really not sure why the company has elected to not raise their dividend, but they've got some things going on. Again, I'll save that for the next video. Bottom line is, I like Walgreens Boots Alliance at these levels. I do think it's a turnaround speculation, and you'd be betting on what the future success of all the initiatives that I kind of highlighted earlier that the company might achieve. So you are kind of, betting on the future here more with Walgreens, but you can buy it at such a very low valuation here, notwithstanding some of the issues that I, showed you earlier, margins and returns on invested capital and equity and so on. But if they improve those things, which management is really focused on doing, this could be a great time to be taking a long-term position in Walgreens Alliance with a nice 4%-ish dividend yield, to kind of soothe the pain that's hopefully continues to grow at 4, 5, 6% a year or better. And as they start growing faster, maybe get back into double-digit dividend growth again. Anyway, that's it on Walgreens Boots Alliance. It's Chuck Carnevale bringing you another subscriber request Tuesday. This time I covered Walgreens Boots Alliance. If you like this content, please give me a thumbs up, ring the bell, subscribe to the channel if you haven't already. I really appreciate everybody. And you might also want to take a look at FastGraphs, the fundamentals analyzer software tool. I personally couldn't even imagine investing in stocks without the advantage that FastGraphs offers me. Thanks for watching.